What's up, guys? We're going to give everybody a couple minutes to join, and then we're going to get started here. All right, we got a little bit of a smaller class today. That's all right. People will join as we get started, but it's 8 o'clock. We're going to get started here. So, what we're going to be going over today is trend analysis. So, basically understanding how the markets move, why they move, and so on and so forth. So, just initial getting started with it. There's basically three types of markets. Okay, so there are an uptrending market where we make higher highs and higher lows. So we can label a few of these here. So here, higher low. And then here, we have a higher high. And then we can keep going with it. There's a higher low here, higher high here, and so on and so forth, right? Okay, so this is what a basic uptrend will look like, right? And then, so then we have a downtrend. Okay, so this is what a downtrend looks like. And to identify this, we have to look at, okay, so there are lower highs. So lower high. And then there is a lower low. And then we have lower high. And then we have a lower low. And so on and so forth. Okay. So these are the basics of what a trend will look like, right? So whenever you're looking at a chart, you need to assess what we are in. Okay. And there's one other type of pattern or not necessarily a trend, but basically another type of price action you will see. And that is a consolidation. So it can be in the form of consolidation like this, where it's horizontal. You can see consolidation patterns, and maybe like these are patterns you'll typically see that people post, like a symmetrical triangle where we have triangle, we have price action that goes like this. We start to form price action within this triangle, price gets tighter and tighter, And at some point, we're going to break out on one side or the other, right? And it's going to make a greater than expected move. Okay, so there's patterns like this, but to keep it completely simple, you need to understand the basics of these three types of patterns. Okay, so there's trending markets, there are downtrending markets, and then there are consolidation markets. And so these are the ones that we want to pay attention to. You need to know anytime we're looking at a chart what we are in, right? We need to know, okay, when we first look at a chart, the first thing you need to know is, okay, is this an uptrend or a downtrend? Because that's going to determine how you trade the chart, right? And so to keep this super simple, you only want to trade upside moves in an uptrending market. So you want to trade calls in an uptrending market. You want to trade puts in a downtrending market. You got to just keep it simple. If you try to trade puts in a downtrend or uptrending market, you're probably going to get burned, or your profits are going to be really, really small, right? And typically you want to catch those bigger moves. And the idea is to get into trades when we're in an uptrend, you want to look for higher low entries. So getting in when we're at higher lows, you want to take entries near that area. And for downtrends, you want to enter in near these lower highs. And so this will give you the best risk to reward on your trades because you're trading with the trend. And as long as it continues to stay in this trend, you will be able to profit off the move that it's making. You need to be able to follow the trend. And as it keeps going, you can continue to hold your trade and continue holding as it continues to trend downward or upward. These are the type of markets we do not want to trade, where we are trading completely sideways. But with that being said, we don't want to trade these markets, but at the same time, these provide great opportunities for what may happen next. Okay, so when we break this down into like a numbers perspective, when you look at these, so we call this trending, right? So there's two types of trends, but this is considered trending. This is considered, let's see here, this is considered consolidation. Okay, so we have consolidation. I may have spelled that wrong. Don't spell check me on it, but consolidation and trending. So the idea behind this is we want to identify what's going on in the market. Is it in an uptrend? Is it in a downtrend? Or is it in a consolidation? Why? Because this here, trending markets happen roughly between 15 and 20% of the time. Okay. It's proven facts done by studies. This happens 15 to 20% of the time. A trending market happens 15 to 20% of the time. And this consolidation phase, although it may not look perfect like this horizontal box here, this happens about 80 to 85% of the time. Okay. And so basically, how you want to look and go about this is just think about it logically. Okay. So if we only do this 15 to 20% of the time, and these are the moves we want to catch, like if you are trading directional trades, like you are buying a stock, selling a stock short, or you're buying calls or puts, you are wanting the stock to go in a certain direction. You're betting on it going in a certain direction. Okay. So what you need to do is you need to make sure that you are catching it at the right time. You're catching the trade at the right time, and you are catching when these trades are starting to trend. So how can we do this? Okay, so with this in mind, 85% of the time, 80 to 85% of the time, we are in a consolidation. 15 to 20% of the time, we are in a trending market. Okay, so this is a very small percentage and this is what you want to catch, right? So, and hence, like you need to understand, like a lot of the time you're going to be sitting and waiting. You're going to be waiting for trades to set up to get into them. Most of the job of a trader is to wait. You have to wait. You have to sit and wait for trades to set up. Majority of the time, you're going to be sitting on your hands waiting for something to set up. Okay. So going further into this, think about it like this. Okay. So if we're in this 85% of the time, if we are not doing this, consolidating or in consolidation, what are we doing? We're trending. We have to be. There's three options. There's essentially two options. Like there's three options, but there's really two options, right? You're either trending or you're consolidating. one or the other, trending or consolidating. Okay. And so with having this in mind, the best time to catch a beginning of a trend is when we stop consolidating. So that's going to enable you to catch the beginning of these moves and just follow the trend and be able to ride your profits into the sun, if you want to call it. But basically what your idea is that you want to catch when the consolidation ends and when we start trending one way or the other, because that's going to give you the highest risk to reward profit potential. Okay. Now there's fake outs that will happen all the time, and that's just a part of trading. You will get faked out. You will have losers. We talked about that last class, but the idea is you want your winners to be a lot bigger than your losers. And how can we do that? When we identify when this 80 to 85% of the time is done and we are starting this 15 to 20% of the time. So if you really split this up, 20% of the time, we may be doing something, and it's not always going to be equal because, the market usually trends up, but this will happen, give or take 10% of the time. And this will happen, give or take 10% of the time, right? It's just in theory. This might be 15% of the time, it might be 18% of the time, and this is 2% of the time. This could be 15% of the time, and this is 5% of the time. But in essence, one of these is going to be happening, and you got to identify when it's happening and which we are doing. And that all comes down to price action. Okay, so let's look at some real world examples. Notice I'm just going to be highlighting consolidation phases, and then when we break out of those and when we have a directional move. Okay, consolidation phase where there's no direction, we're just chopping in between, and then we have a directional move down. Okay, they're not going to look perfect, and it takes your eyes to train it for a bit to see them. Consolidation phase, directional move. Consolidation phase, directional move. Now notice this is a somewhat of a consolidation phase, but it's headed upward. So that makes it even more obvious that we are probably going to head upside, right? If we go look at the overall market, so SPY, really easy to identify here. Consolidation phase, trend. Had a little bit of a consolidation phase that was pretty wide, right? But then we ended up trending. Consolidation phase, trending down, consolidation phase, upside break into a new consolidation phase. Consolidation phase, breakdown. Now this is a very clean consolidation. Same with this one here. Clean consolidation, no direction, just chopping back and forth. We had a break, upside move. We had a nice move to the upside. Okay. So you can find this all over the charts. Consolidation phase, breakdown. Consolidation phase, break upside, a little bit of a consolidation phase, break upside. Consolidation phase, you can see that this goes on and on and on. You can find this on any chart. You can find them on any chart. Smaller consolidation within a larger consolidation and breakdown. Consolidation phase, breakdown. Consolidation phase, breakdown into a new consolidation phase, and then we broke upside. Just happens over and over and over and over again in the market. You can find this on any time frame. You can find it on any stock chart. And what these are considered to be called is, we go back to Apple where my charts are, what this is called, and to keep it really simple, is an impulse correction. So we have an impulsive move up, and then we have our correction. Impulsive move up, correction. Impulsive move up, correction. Sometimes the corrections will be sideways, impulse. Correction might be sideways, impulse. Okay, so it happens over and over and over and over again in the market. Just continues to happen over and over again. And so this can happen. So in a downtrend, impulse, correction, impulse, correction, impulse, correction, impulse. And this is how you're going to be able to find your trades. So you're looking for these moments in time when there's no direction, and you're looking to find which way is it going to break out, or which way is it going to start trending in the next moment in time, right? So like if we go back to the SPY chart and we just take a look at this, we have a consolidation here. But more than likely, which way are we going to end up going? I mean, we're in an uptrend. So we created an impulse upside, and then we started correcting sideways. And then what do you know? Next thing you know, once we broke out of the consolidation, we had our move up. And then just this continues to happen over and over and over again. So here's the reversal. They're not always going to follow the trend, right? So there's the correction, or sorry, there's the, yeah, this is the correction. So basically what we had was from here, we had consolidation, impulse, consolidation, which is right here, this right here. And then we had another impulse, then we had a consolidation, and then we had an impulse, and then we had some sideways consolidation here. Notice how we trended downward, but not very strong, and then we pulled back up, some more consolidation, and then we ended up consolidating, moved down. And then we had some more consolidation that started to push upside. So this was like, so this is where you can kind of build patterns into what you're doing, right? So like, as you can see, we're kind of creating an upside trend, a little ugly rising wedge, right? And then we eventually broke out of it, upside, and continued the upward trend. So this just happens over and over and over again. And so you can see here, consolidation, breakdown, consolidation. And so another term for this, you might have heard this if you've studied different theories of stock market analysis and stuff like that. And the easiest way to break it down, like they call it accumulation and distribution. So big money, so like the banks, institutions, hedge funds, things like that, they cannot buy and sell like me and you do. Like they can't buy and get into contracts and get out and not affect the markets. They're trading with millions, billions of dollars at a time. So when they get into a position, it takes them a minute to get into their positions. And I say that metaphorically. It may take them days, it may take them weeks to accumulate their position, depending on how long, it just depends on how much money they're trying to put in, right? And the same thing happens when they got to sell out too. Okay. So accumulation is literally what it sounds like. Accumulation. They're accumulating shares. Distribution means they are distributing shares. They're getting rid of shares. And so during these consolidation periods, they're going to be one of the two. They're going to be the accumulation. I may be spelling this wrong. Don't spell check me, like I said. Okay. Accumulation. Okay. So now we can go ahead and identify these. It's the same thing. Okay. What do you think this is? I'm going to do A for accumulation. Look, accumulation chopped around, and then look at the directional move we had. We had a directional move from about 385 up to 415. If you know anything about options, that's a lot of money in making money in options, right? Like that is a huge 1,000%, a few 100% at least move, right? This would be considered a distribution phase. Put a D there. Distribution. They're distributing their shares. Once they feel like they have gotten out of enough shares and they've liquidated enough of their position, they've gone short, then they can push it to the downside. And then, okay, there's the accumulation, and then we have our move up. And then what do you know? We have a new distribution phase. Here's a new distribution. Okay. And then we have our move down. And then we have, see how price action is not very directionally strong, how it kind of chops upside, like it's very choppy. Like, look at this. So we had a gap down, gap up, gap down, gap up, gap down, flat, gap up, push down hard, inside day, inside day, inside day, inside day. All these candles are within this one day. All the price action is within this one day candle, right? And so the price action is not directional, right? This is a accumulation, okay? And your job as a trader is to figure out, okay, is this an accumulation or a distribution phase? So when we look at this impulse correction, this is how you know when a move is going to begin, right? Okay, so now I can show you some of the, like, does this make sense to everyone? Between accumulation, impulse correction, they're all the same thing. They are all the same thing. Impulse correction, accumulation, distribution. The whole point is you're looking for what people call on Twitter, quote unquote, chop. That's what we're looking for. Like, you're looking for these periods of time where there's no direction, because this is going to indicate that we are in this, when we see this chop, we are in this period of 80 to 85% of the time that it happens. And what you do is, okay, now you got to figure out, where's it going to go next? Where is it going to go next? Is it going to go up? Is it going to go down? Is this accumulation or distribution? Do you long options contracts? Yes, that's a majority of what I trade. And I'll show you a couple examples in a minute. But so yeah, so basically that's what you're looking for. Your job as a trader is to figure out, okay, identify these times when there is 80 to 85% of accumulation or distribution or consolidation, all the same thing. Just call it consolidation. When we have this 85% of the time when there's a consolidation, you're looking to catch this 15 to 20% of the time when it starts trending. Now, this may become really evident. We go look at that a weekly chart. Distribution, accumulation, accumulation, accumulation. Let's see, accumulation. All of these is just chop. So look, if we go and draw this price action, let me clear this off. Look at this. And we just draw on top of this price action. Impulse, correction, impulse, correction, impulse. Oh, look at this. Smaller time frame correction. Impulse, correction, impulse, correction, trend shift, correction, impulse, correction, impulse, correction, impulse. It's not always going to look pretty. That's the whole point of the markets. If it was really pretty and everybody could see it all the time, then everybody would be traders, right? Nobody would go be a doctor. It's too easy to do it, right? So look at this. Accumulation. Look what drove us to move up. I hope this makes sense. So basically that's what we're looking for, right? We're looking for these periods of time when there is a correction and we can enter the trades. So you can call this correction when you're drawing this out in an uptrend. You can call these correction points your higher lows, right? They all are the same thing. They all play into the same thing. They all are the same thing. These higher lows, when you catch them, they're a part of the correction. They're a part of, here's the impulse, here's the correction, impulse, correction, impulse, correction. Okay, so I'll show you guys an example of a trade that we took this week. Okay, so we took Walmart this week. We go to the daily time frame. As you can see, right now, we are in a weekly correction, or yeah, weekly correction, right? We go to the daily time frame. I notice this here. Here's a clear consolidation. Why did I guess that we were going upside? Probably because we've been uptrending. And that's why I decided that we were going to go long, right? It may sound simple, and I might be making it simpler than it is, but once you've been doing it for a minute, you'll be able to see it. This is a correction. We're holding just like this here. Here's another correction. Correction, accumulation, pop. Accumulation, pop. That's what we're looking for. And so basically we went long. We actually went long and bought options contracts or calls here on this day. Next day, we're up 70%. Then we decided to hold, and then we were up 110, 115% by the next day, or 2 days later. And these were next month's expirations. So these expired in August. So same thing. All I was looking for, okay, here's our correction, here's our accumulation phase, so on and so forth. We had our, if we go look at the lower time frames, you can really tell it's a consolidation phase. you can really tell it's a consolidation phase, right? And then notice, add on top of that, where's that little drawing that I like to use? Right here. There we go. And then check that out. Inverse head and shoulders. Just a part of the accumulation, the consolidation, the 85% of the time that we're in. And what do you know? The next day we caught that directional move. What time frame you use for day trading and swing trading? I use all time frames. I know you'll probably hate that answer, but I do use all the time frames. I don't use just a single time frame. I gotta have it agreeing on multiple different time frames for me to like a trade. Like this one. Yes, I saw it on the daily time frame. I like that. But if you go look, weekly time frame looks good. We were forming a flag just below the highs, and we were holding above this double top. And then if you go to the 4-hour, you can see we were starting to create this pattern of inverse head and shoulders. It was more obvious on like the 2-hour inverse head and shoulders. We were creating this kind of like, I wouldn't call it a bear flag, obviously, because we broke upside, but it was more of like this symmetrical triangle type deal. And so I had multiple time frames agreeing with what I was looking at. We had a weekly break of resistance, now it's turned to support. We had a daily hold above the EMAs, showing me that we're continuing to hold the uptrend. And then you go to look at the 4-hour, we had an inverse head and shoulders, and with this whatever this is, whatever you want to call it, symmetrical triangle type deal. And then the 1-hour, same thing, inverse head and shoulders. So I had like multiple time frames that were agreeing with this trade that made me want to take it. So yeah, it's not really just one time frame, it's a lot of different time frames looking at them. So yeah, that's one of the trades we took this week. Same thing, let's see. This might not be that great of an example, but we'll try and use it. Okay, so this is an example of a day trade we took this week. And we caught a few 100% on SPY. But okay, so notice this. What is this here? Consolidation. Okay, notice we were starting to break down. Look at this. Head and shoulders pattern, right? And then notice not only that, consolidation. We go look at the 15-minute. We were starting to break down. We entered on this candle right here. Once this candle closed and we pulled back to this EMA right here, I signaled entries to the chat and then just held. And then boom, we had a breakdown towards the end of the day and we had caught a really nice move off. It ended up being a few 100% on options contracts. I play futures, so for this was about each point is $50, so this ended up being a little over $1,000 each contract. So that's just a simple day trade that we took. And so I noticed it on multiple different time frames. I was looking at the 15-minute, I was looking at the 1-hour, I was looking at the 30-minute, and then once you can spot these points in time, we entered in on this. After this candle closed, we entered in on this one, and then we had a nice move almost immediately after. And so that's what we're kind of looking for. And here you can see most obviously, like here's a clear consolidation. It's really obvious on the 1-hour consolidation, and then boom, a move down. So that's basically what you're looking for when it comes to finding trades, really. And kind of understanding the way the market moves and why. I gave you, so just to kind of recap it, let's see. Go back here, just a quick breakdown so you guys can fully understand this. So you have 3 different types of trending markets. You have the uptrend, you have the downtrend, and you have the consolidation. The consolidations happen 80 to 85% of the time. So your job as a trader is to identify that 85 or 80 to 85% of the time and try and catch this 15 to 20% of the time that it moves like this and makes an upside move or downside move. And that's your job as a trader, to find those points in time, especially if you're a directional trader. If you're selling premium, it's a little different, but it's the exact same concept. And so that's what your job is, to find these periods of time. And so I showed you a couple of different examples. Walmart, we had this move up, we had a nice trade, 85%. We had that ES I just showed you. Here's another day trade of what we took. How can you tell if it's going up and down? By using the trend analysis and looking at the way I'm doing a full breakdown. And this is more of understanding the basics of how the market moves. But right now I'm doing a series called Catching the Big Move for the Signals chat. The people that sign up for getting our alerts and stuff like that. And I do more in-depth breakdown analysis on exactly how I take my trades and stuff like that. But yeah, we have a 7-day free trial for that. If you're interested in joining that, it's 7-day free trial. So you don't have to put up any money if you hate it. You don't have to be in. You can cancel it before the 7 days is up and you can be out. But I will say last week we had somebody join for the 7-day free trial, and before their 7-day free trial was up, he made $600 off of 2 of the alerts that I called out. And he paid for, I mean, the membership is $19 a month. And so he paid for over 2 years of his membership fees with his 7-day free trial. So I try to make it really cheap. So it's anybody can be a part of it and join. And it kind of, as you can see, it kind of pays for itself. Yeah. So yeah, I do a more in-depth breakdown. I give really deep teachings and classes on how I take my trades and how I do all of that. We'll kind of get more into that, but a lot of this is teaching the basics. I'm not going to necessarily teach a strategy. It's more about teaching you how to understand the markets and read them. And then you can either develop your own strategy, you can come join us, check us out, and so on and so forth. But yeah, we got a 7-day free trial going on too. So this is another trade that we took earlier this week. You can see here is another phase of consolidation on snow. And so how we took this, and you have to sign up for you're saying, can you email the link for the class? You're going to have to sign up for the Signals chat, and all the links are posted in there within the Discord for you to watch. They're all recorded and posted. We just did one actually right before this class, so you'll be able to access that one too as well. And I break down exactly how I took these trades and found them and my setups and stuff like that. But so market structure is key though, right? Like break a structure, change the structure, and so on. Of course, paying attention to, yeah. So you can use market structure to kind of determine which way the stock is going to go. I use market structure. People that have been with me for a minute, they know that I use market structure a lot. But yeah, I do use that. But I use accumulation, distribution, consolidation type phases to be able to get in early and be able to catch the full move. And like, so for example, like this one, this was your break of structure here, but I was in down here. And so I got in here and was able to sell when everybody was trying to buy in, right? And so all these people that are putting up their money to buy in, the demand of the contracts are going up. So in addition to the contracts moving in my direction, or the stocks moving in my direction, so I'm making money off that, I'm also making money because a bunch of people are trying to buy it now that they see these breaks of structure and stuff like that. They see that, they're trying to get in, and I'm already getting out of the trade when they're pushing up the premiums because they're buying the contracts, which makes the demand go up, and the prices of the contracts naturally go up because there's more demand. And then also the stock is moving in my favor. So as you can see on the 1 hour, you see this consolidation phase, and then you can see on the 30-minute, same thing, consolidation phase, and then 15-minute, you can also see the consolidation phase as well. And so we entered in on the trade here, held, and then next day we sold for 115%. And yeah, that was it for that trade. It came up, hit my target, which was this high, it was showing a pretty clear resistance level right around this area. So whenever we hit that level, I decided to take profit. And yeah, so we got in right around this area here and then sold for 115% the next day. But this was more of a short-term swing day trade type deal. And yeah, so these are all trades that I just took this week. So it's not like something that doesn't work all the time. Like this example of snow I took this week. Walmart I took this week. The day trade on ES I took this week as well. Yeah, so these are all things I use this on a day-to-day basis. I use this all the time. And yeah, so this is kind of your job. Your job is to figure out those periods of time where we are consolidating and then be able to catch the break of the consolidation when it does happen and basically catch that next move for the uptrend or downtrend and figure out which way it's going to go next. But yeah, so that's really it for this class. In terms of teaching, like I said, if you're interested in the signals chat, we have 2 classes a week for that there. We have one right now. We're adding a new one next week, where another one of our analysts is going to be doing classes. But we have signals from 2 different analysts. We have an analyst that does charting, and then we also have a class once a week from the charting analyst, and then class from me, obviously. And then yeah, we have a 7-day free trial, $19 a week, or $19 a month, sorry. And like I said, we haven't had a month yet where the signals don't pay for themselves. And then at the same time, you also get classes that are going to help you improve in your trading that's more in depth than this, and kind of give you my actual trading strategy, how I trade, what I look in the markets, and then also my trade alerts that I take in real time. Yep, no problem. Happy to help. Thank you for coming. Do you chart support and resistance on open, close candle or high of lower candle? The way I chart support and resistance is based on, I wouldn't call it pivot points, but more so direction or major points of where we change direction. So basically where it hits a certain price and we move in a strong direction, like right here. I would call this a level here because we had a strong move after that and rejected that way. So yeah, so that's kind of how I draw support and resistance. We'll get into that more as we go through these back to the basics classes. But yeah, thank you guys for coming. If you want to join the signals chat, I'd love to have you there. I know we can add a lot of value to you and definitely help you out in your trading for sure. So if you guys are interested, the link is in the Discord. And yeah, so thank you guys for coming, and see you for the markets tomorrow.